All right, well, let's go ahead and get started. Welcome, everybody. Good morning or good afternoon, depending on where you are in the country. Excited to be with you today. So what we're going to be talking about today is everyone's favorite topic, the economy. I'm hoping I can make it more interesting than your high school or college economics teacher, but we will see. So really felt like this was a good time for us to head back to basics here, because so many of the words and phrases that we are seeing in the news regarding the economy are hard to avoid. And it's hard to know exactly what each of them mean and more importantly, how each of them impact you. So we're going to spend a lot of time there today, really discussing the most important topics of our current economy and how that is impacting you as a consumer. So just to introduce myself first, my name is Ryan Emerson. I am a Senior Vice President and Director of our Wealth Builder team here at Curi RMB Capital. A bit of my background is I've been in the financial services industry for about 13 years at this point, really working with individuals and families across the United States, helping them really make important decisions in their financial life today so that they can be on a better path going forward. So just want you to know, we're going to talk very high level about a lot of information today, but if you have any questions, concerns, or would like to spend more time one-on-one, you can actually scan that QR code you see here. It's not going to take you to a menu of your favorite restaurant. It will actually take you directly to my calendar. So feel free to utilize that. You will also see it again later in our conversation. So if you're fumbling to get out your phone right now, do not worry, you will see it later. So just to talk a little bit about Curi RMB Capital, kind of who we are. Really, we are a full-service wealth management firm. So as I mentioned before, I run our Wealth Builder team, which is really focused on foundational financial planning. We have our wealth management offering that really is for more complex needs. We have our retirement plan solutions that helps companies set up great 401k or 403b plans for their employees. And then we have our asset management team as well that really interacts with all of these groups. So we manage about $14 billion today for about 3,200 families across the nation and are continuing to grow. So quick disclosures, our compliance team wants us to let you know that today is for informational purposes only. This is not legal or accounting advice. Please consult your legal and or accounting professionals for such advice. All right, well, now that we have that out of the way, let's go ahead and talk about the economy. So really what we are talking about is how money and resources move between people, businesses, and governments. At its most basic, the economy is the system for producing and exchanging things. So that can be goods, services, and money. The economy really is all around you. You work to earn money, you spend that money, businesses are selling goods, creating jobs, governments are spending on roads, schools, military, and other social programs. Trade is obviously a big one, a lot of trade talk these days, and all of these hundreds, if not thousands, tens of thousands of decisions, whether that be working, buying, selling, and saving, add up to create the economy. So it's important to know really who are the key players in the economy. Consumers. 70% of the US economy is driven by consumer spending. So businesses play a huge role in it. They're the ones creating jobs, producing goods, and investing in growth. Government is obviously a big part of it as well. So they spend on infrastructure, defense, and social services. And then international trade continues to play a big role in kind of our world economy today and is impacting us here at home. So really understanding the economy is really just understanding how we all live, work, and build together. So let's walk through a couple of key kind of economic indicators. The first one being is GDP. This stands for gross domestic product. Really, it is the simplest way to describe the size and health of the economy. So GDP measures the total value of everything produced in a country during a specific time period. It includes everything from goods, services, as well as government spending. So as you might imagine, growth in GDP is good. Declines are seen as bad. So why does the GDP matter to you? So GDP growth often leads to more jobs and higher business earnings, which can boost the stock market. GDP can also influence policy decisions. The government and Federal Reserve closely monitor the GDP to help decide when to adjust interest rates, taxes, or spending to help keep our economy stable. GDP is also going to influence investor confidence. A strong GDP may boost the stock market, and a slowdown may make investors cautious. Next one for us to review is inflation. Inflation really is just the rate in which prices for goods and services increase over time. A little bit is totally normal. Too much can be very, very disruptive. So this is measured by the Consumer Price Index, the CPI, and Producer Price Index, which is the PPI. The Federal Reserve typically targets about 2% inflation for healthy growth within the economy. Unfortunately, a kind of key example that we have all been living through the past few years is that we've seen inflation spike. Part of this is due to supply chain issues, kind of effects of the pandemic, which led to a lot of stimulus spending. So how can inflation really impact you? Well, prices, of course, costs for goods for everyday things like groceries, gas, housing, and healthcare. Those are the big ones that are going to impact us. One other key item of it is purchasing power. When inflation's high, the value of your savings can be diminished. For example, if you saved $10,000 a year ago, but inflation was high at 6%, the value of that $10,000 would be reduced to $9,400. So the dollar amount doesn't necessarily decrease down to $9,400, but what you can get with that money today is the equivalent of what $9,400 could get before. So interest rates as well are an important piece of this. They might go up. We'll talk a lot more about interest rates on our next slide. Wages and jobs are also impacted by inflation. So when inflation increases at a pace faster than wage growth, people may feel a reduction in purchasing power and things may be more expensive. Let's talk about interest rates. An interest rate is what it costs for you to borrow money for things like homes and cars. Interest rates influence how consumers borrow, spend, save, and invest. For example, if you take out a $30,000 loan to buy a new car and you have an interest rate of 5%, you're going to be paying $1,500 in interest each year. So raising rates make borrowing more expensive, which really is intended to slow spending and help cool inflation. Lowering rates, on the other hand, encourages borrowing and investing, which ideally stimulates the economy. So how does this impact consumers? Borrowing costs, like I just mentioned, higher interest rates make loans more expensive, monthly payments go up. Saving and investing, well, higher rates mean better returns on savings accounts, CDs, some bonds as well, which encourages people to save money instead of spending. This is also going to impact spending power. When borrowing gets expensive, people and businesses often spend less, which can slow down economic growth. The housing market has seen this over the past 18 months, where mortgage rates have risen. Home buyers can afford less. This is intended to really cool down the real estate market. So last piece here that's impacted is the stock market. Really higher rates can pull money away from stocks into safer investments like bonds, leading to a bit more stock market volatility. Tariffs and trade is really our next one. This has been what I would say a constant headline really over the past few months, especially at the beginning of April. So it's important to know really what these are. So tariffs really are just a tax on imported goods. The purpose typically is to protect domestic industries, potentially retaliate in trade disputes, or raise internal or domestic revenue. So the benefits of tariffs, they can protect jobs domestically, they encourage local production. However, the cons can lead to higher consumer prices, trade tensions, and potential retaliation from other countries. The example that we've seen really playing out, it seems like day to day, there's new news on it, is tariffs on Chinese electronics. These have led to what we're expecting to see is higher prices on TVs, smartphones, and other gadgets. So why does it matter? Again, trade affects the cost of goods, supply chains, and global competitiveness. So how tariffs and trade impact consumers like you and I? When tariffs are added, companies often pass along extra costs to consumers, making everyday goods like the electronics I mentioned, clothing, groceries, more expensive. It can also lead to fewer choices. So higher tariffs can discourage imports, meaning fewer product options on shelves. It can also increase business costs. So companies facing higher import costs may cut jobs, they may raise prices, or really reduce their innovation to stay profitable. Big one we've seen is global tensions. Trade disputes, trade wars, in other terms, can create a lot of uncertainty, which can impact markets, investments, and the overall economy. So let's talk about the stock market. The stock market is where shares of publicly traded companies are bought and sold. It reflects how confident investors are about future company profits and economic growth. So when investors believe in future growth, they're going to buy stocks. When they worry about inflation, rate hikes, or recession, markets may drop. So much of the stock market is driven by just a few of those things: company earnings, economic indicators like we've already covered, interest rates, Fed decisions, global news and events are all going to impact the stock market. So how does the stock market impact you, the consumer? Well, one big thing is the wealth effect. Rising stock markets can make people feel wealthier. If your 401k or IRA or other investments are going up, it actually can encourage more spending. Retirement savings, obviously this is something that many of you are focused on. Many retirement accounts are tied directly to stock market performance. So a strong market boosts savings, a weak market can shrink them. Business investment is also impacted here. High stock prices make it easier for companies to raise money, to grow, hire, and innovate. Confidence levels are also a big part of this, in that a rising market often signals optimism about the economy. A falling market can spark fear and lower consumer and business spending. So sticking with the stock market here, market ups and downs are really a natural part of long-term investing. While volatility can be a bit unnerving, really understanding the frequency and severity of market declines can help keep things in perspective. So let's go ahead and define some of the key terms that you likely hear regarding markets. So the first one is pullbacks. Pullbacks are a 5 to 10% decline in stocks. So this is the most common type of decline. This happens about 3 times per year on average, believe it or not. These short dips can be caused by factors such as economic data releases, changes in interest rates, or short-term investor sentiment shifts. So my big takeaway for you is pullbacks are normal and they're typically short-lived. So overreacting to them can really lead to unnecessary adjustments that may disrupt long-term financial strategies. Corrections is our next one. This is a 10 to 20% decline. This is what we saw at the beginning of April this year. A correction is a more substantial decline, typically happening about once per year. Corrections can result from broader economic slowdowns, global uncertainty, or shifts in corporate earnings expectations. So again, the big takeaway here is historically, markets have rebounded from corrections, and those who stay invested may be better positioned to benefit from that recovery. The next one is a bear market. Many of you have heard that bear versus bull terminology. Bear markets are the downside, 20% declines. These are the most severe downturns. Really, they occur about once every 6 years. These periods are often linked to recessions, financial crisis, or major geopolitical events. So while some bear markets have lasted over a year, others, like the sharp downturn in early 2020, have been much shorter. Really looking back at 2020, thinking of when the COVID lockdowns were announced, most of us, that was about March 13th or March 14th of 2020. The stock market, believe it or not, actually bottomed out on March 21st of that year. So keeping that in mind. We don't expect that to always be the case again, but even during these bear markets, recoveries have historically followed. Investors who maintain a long-term plan and avoid emotional decisions may fare better over that time. All right, bull markets, really this is a 20% incline. The opposite of a bear market, this is the one people like much more, of course. Really, a bull market is typically defined as a 20% increase from recent lows. So we see a bull market about every 5.5 years on average. So why does it matter? Really, why does everything we talked about today matter for you? Inflation affects your real income and your cost of living. Interest rates impact everything from home buying to saving for retirement. Tariffs can drive up prices for everyday products. The stock market performance impacts your investments, even if you're not one of those folks that's trading every single day or even trading at all. Economic cycles are going to shape job availability, wage growth, and long-term planning as well. So all important factors when you think of how am I situated, how am I saving, how am I investing, these are all important pieces for you to be thinking about. So that's really what I was hoping to cover today. Really economics 101 in about 15.5 minutes. So thank you again for taking the time to be with me. I know there's a lot of information in here, a lot to take away from it. And I would really just emphasize to you that if you feel any uncertainty today, make sure you are reviewing your own plan so that you can be more confident going into the future. I'm here to help you, so please feel free to use the QR code here to grab some time to connect on a more personalized basis. But we're going to turn it over. I think there were some questions that we received throughout the call, so we'll do a few minutes of Q&A. But again, thank you for taking the time, and feel free to reach out if you have additional questions.
Thanks, Ryan. Hi, I'm Belen Ryan, and we have gotten some great questions coming in through the chat. Just as a reminder, you can either, if you have questions right now, you can unmute and speak up. You can also send them into the Q&A box, and I can read them for you anonymously. Or like Ryan was saying, if you have some personalized questions, please feel free to schedule time with him directly, and he can walk you through a deeper analysis. Okay, Ryan, are you ready?
Ready.
Our first question. What kinds of services are included in the GDP?
Good question. So really it's expansive, right? We can go as simple as a haircut is going to get counted towards GDP. The services that we provide to our clients as well are going to be counted towards that. So really it is including all services that we see within our economy.
Awesome, thank you. Our next question is, why doesn't income rise at the same rate as inflation?
I wish I had the perfect answer for that, but the fact is a lot of that is going to be based on specific businesses, industries that are not necessarily going to just raise wages to match inflation. I know this was a big topic throughout much of the business sector during years like 2020, 2021, where we saw spikes in inflation. It was, hey, why did I only receive a 3% pay increase when inflation was at 10% this year? So unfortunately, the two do not always align. There is always the hope that wages will increase with inflation so that cost of living does not become an issue for more and more people, but they are not always tied perfectly together.
Thank you. Our next question is there such a thing as investing wisely during times of volatility and high inflation?
I would say yes. Again, this brings me back to what I was saying before. When you think of kind of your investment strategy today, I think during market run-ups or those bull markets I was talking about, we see a lot more risky behavior. Folks going into heavily concentrated positions or chasing returns, chasing just a few companies that have done well recently. That can create a lot of risks that can hurt your portfolio badly when it comes to pullbacks like what we've seen at the beginning of this year. So we always want to focus on owning high quality companies when it comes to your stocks. Not everybody should be 100% in stocks either. You should be looking at bonds. You should be looking at cash alternatives. There is no perfect one size fits all solution. So if you think about investing wisely, I would recommend just having a strategy that you have confidence in and knowing that you own companies that are going to be able to kind of go through these types of downturns and ideally come out the other side.
This one kind of goes along with that. How does someone actually buy a stock market dip? What do you mean by buy?
Yeah, good question. The buy the dip is probably something you've seen flashing on CNBC or whatever your preferred news channel is. The how you go about doing this, many of you, if you have a brokerage account or use a custodian such as Fidelity or Charles Schwab, just to name a couple of them, if you have an investment account or IRA or 401k, buying the dip really just means putting cash to work, maybe cash you have on the sidelines, into the stock market when we have seen one of those pullbacks or corrections. So that's really what's being referred to from that standpoint, is getting excess cash off the sidelines, or maybe you had part of your portfolio that was too conservative and you can take funds out of there, put it towards stocks and buy the dip.
Thank you. Let's see, which one next? Trying to give you, let's see. Okay, here's a challenging one. This person asked, tariffs already seem to make things more expensive. How long do you think it'll last, and what can I do to keep costs low?
Yeah, good question. Many people are starting to see the impacts of tariffs. When we look at kind of the relationship between China and the United States, that there is a lot of trade that is occurring on a daily basis. So when we look at kind of the supposed trade war that's now going on, we as the consumers start to feel that pretty quickly. So what I would recommend is that, or what I'm thinking about is, I can't predict the day that it's going to stop. We hear headlines just like you do. We have to focus on what we know, is that tariffs on Chinese goods are going into place, and they could come down at any moment. So there's a lot of headlines that we can't predict. There's no necessarily crystal ball on when tariffs will stop. So when you think of your own personal budget, I would focus on budgeting, again, knowing what you have and can spend and trying to stay within that range. So I wish I could give you the perfect answer. Unfortunately, we can't predict exactly when things will slow down. I know sometimes the tariffs only last a week. Sometimes they can last much longer.
Thank you. Our next question. Between investing regularly and investing during market dips, which strategy is generally more effective over the long term?
Good question. So my answer is to invest regularly. A lot of folks, if you are still working and have a 401k available to you, that is an easy thing to be doing. You are investing every other week or every paycheck. This is proven to be one of the most successful strategies long term. It can be seen as dollar cost averaging, where you continue to buy in despite where the market is at any one given day of the month or day of the week. You are consistently buying. That is a very good path towards long-term success. So when we look at investing on downturns, I think it's important to remember that you're really just buying when things are low at those reduced rates, and it's having the courage to do so. Again, you can never predict if it's going to continue to go down or if it will recover the next week or next month or next year. But when you are consistently investing the same amount every paycheck, that can help set you up for long-term success.
Thank you. It looks like we have 2 more questions in our chat box, so just right enough time. Our next question is, I am hoping to retire in 5 years. What should I be doing with my 401k right now?
That is a very personal question, and congrats on retirement coming up. Really what I would say is it is, if you are not working with an advisor already, it's an important time of your financial life to be engaging with a professional, just to make sure you have a strategy in place. When we look at kind of those last few years of pre-retirement, you may have more opportunities for saving, additional savings into your 401k. You need to be thinking about different types of accounts you can save into, whether that be pre-tax, Roth, after tax, because those will all play an impact on your financial landscape when you retire and you flip to actually using your money opposed to just saving your money. So advice there is to make sure that you have a plan where you're saving enough today, that your goals are realistic, so that you can be comfortable during your retirement years. And congratulations again. You're almost there.
Our last question, and this one's kind of a doozy, so apologies. The market seems way crazier than it has ever been. Is that just me, or is it really more volatile?
You're not crazy. It is absolutely been one of the most volatile kind of 5 to 6 weeks looking back that we've ever seen. So when this type of volatility happens, again, we have to focus on what we know and admit what we don't know. A lot of this volatility has been somewhat self-imposed through unexpected tariff rates that are much higher than anyone would have thought. Despite expecting tariffs, we didn't know what was going to be announced on April 2nd. So the most interesting thing to me is when we look at April of 2025, the market had some of the biggest volatile swings that we've ever seen. But all in all, the market only finished down. I'm talking about the S&P 500 only finished down for the month about 1%. The NASDAQ was flat for the month. So keep that in mind that despite volatility, the appropriate path for most is to not make large emotional decisions and pull money out. Because if you did so the second week of April, you would have missed out on one of the fastest recoveries we've also seen.
Thank you. So that wraps it up for our questions in the chat box. Ryan, I'll let you wrap us up and close out.
All right. Well, thank you again, everybody. It was a pleasure to be with you today. We will have a recording of today's session as well. I hope you took a few items away. Again, we're here as a resource for you, so do not hesitate to reach out. But I hope you have a great rest of your week, and thank you again for your time.